Well, ladies and gentlemen, good afternoon and welcome. Thank you for joining us today. We very much appreciate you taking the time to do so. My name is Robert Smith and I'm Chairman of Alliance Trust. And I'm joined by two of my fellow non-executive directors, right down the front here, Gregor Stewart, who's Deputy Chairman, and Chris Samuel, and they'll be joining us when we get to questions later. We're here today to tell you more about the new investment approach. But before we do so, you may have noted the statement released on Friday concerning Elliott Advisors and a proposal as regards share buybacks, which the Trust has been conducting. Now, under this proposal, which is subject to your vote, the Trust will buy back Elliott shares at a discount to net asset value, broadly in line with where the shares are currently trading. That's at 4.75% discount, and that versus today 4.75% in the market, which I checked about an hour ago. Now, the board believes that that's in the best interests of all shareholders. It'll provide an immediate uplift in net asset value to the benefit of continuing shareholders, and it removes the long-standing question regarding Elliott's long-term intentions as a shareholder. We believe that this, together with the new investment approach you're about to hear about, really represents a fresh start, a new chapter for Alliance Trust. With that, I'd like to focus on the new investment approach, and I'd start by introducing you to our proposed new investment managers. That's Craig Baker, who's on the far side from me, and David Shapiro, nearest me, from Willis Towers Watson. I'll call them WTW for short. I'm going to hand over to Craig and David shortly to talk you through the approach in detail, but before I do, I wanted to set out the background as to how the board arrived at this proposal. Last year, we promised shareholders that we'd conduct a thorough review of Alliance Trust. The purpose of this strategic review was to look at how best we could improve the Trust performance. Our aim is that the Trust should be a must-have in your portfolios, beating the market in the long term, but to be safe and sleep at night. In short, to deliver consistent outperformance. It should offer great value for money, and it should be innovative, market-leading investment trust, giving you something you couldn't easily achieve yourselves, but at a competitive cost. And to allow us to continue our progressive dividend policy, we're very proud of the 49-year unbroken track record of dividend growth, and we very much want to continue this. Over the course of the last year, we evaluated carefully a broad range of options with an open mind and a clear line of sight on our objectives. We assessed our wholly owned manager, Alliance Trust Investments, ATI. Now, ATI has delivered a pretty good performance over recent years, but we decided its specialism of running money focused on sustainable investments would be better served with another owner. And I'm pleased to say that we're confident that Lion Trust will be a good home for ATI. We considered appointing a single new manager. However, the inherent challenge of this is that one manager would always have a particular style, deriving performance from certain type of stocks or market conditions. And further, should that manager underperform, the cost of disruption of having to change would be significant. Finally, we understand that you only want to pay for active management, not the so-called index-hugging or semi-passive portfolios, and you didn't want us to give you something you could already buy elsewhere. These are some of the reasons that we decided to propose a highly active multi-manager approach, one that we think is unique in the investment trust world. It's a more sustainable and robust structure than relying on one single manager. It allows us to access specialisms in the market that no single manager would have across the board, and it should deliver more consistent outperformance. What we're proposing is to work with the best equity managers in the world, excellent fund managers, each of which will select only their best 20 or so stocks. Now, to help us to adopt this approach, we needed expert resource. And after a competitive tender process and with unanimous board support, we decided to appoint WTW. So why WTW? Well, they are able to get access to the world's very best investment managers. Their scale, they advise on some $2 trillion of investment, gives them much better buying power as regards fees than Alliance alone. And perhaps most importantly, they have a strong track record in selecting outperforming managers. This slide shows the outperformance of WTW's top-rated managers net of fees over the last 17 years. Craig and David from WTW will take you through the specific track records of funds that are managed in a similar way to that being proposed for Alliance Trust. Now, in terms of how we will work with WTW and the selected managers, the board will remain entirely non-executive. We will be supported by a small central team based in Dundee, focusing on company secretarial matters, marketing, and so on. WTW will be our appointed investment manager. They will have full discretion to pick the fund managers for us, each of which are one of the world's very best. Well, with that, I'd like to hand over to Craig and David to set out the reasoning behind the new approach.
Well, thanks very much, Robert, and good afternoon, everyone. It's a genuine privilege to be stood here in front of you today. A privilege to be associated with Alliance Trust, given its standing in the industry and its long and successful history. But also a privilege to be the first to get to take you through the detail of the new proposed investment approach. So what is this new approach? Well, to put it simply, Alliance Trust are making it possible for the first time for UK retail investors to get access to the best of the best. And by that, we mean not only getting access to the best stock pickers anywhere in the world, no matter where they're located, but also asking them not to give us the portfolio that they would normally run for their other clients, but to just give us their very, very best ideas. So let's dig into that in a bit more detail. David's going to introduce you to the managers that we're putting forward for Alliance Trust Day 1, but there's 8 of them. And of those 8, only 3 of them have any presence whatsoever in the UK retail sector. And none of them are available to UK retail investors or any other investors in this best ideas portfolio that's being tailored for Alliance Trust. So this genuinely is innovative and giving you access to things you otherwise couldn't. But how do we get to those 8 names? Well, at Willis Towers Watson, we have one of, if not the largest, manager research teams in the world. We have 115 people that all they do every day is go out and research investment managers, trying to identify the ones that are most likely to produce the best results going forward. To put this in perspective, half that team cover equity managers, and we cover around 3,700 equity managers. And we meet managers every day. We're doing around 1,000 meetings in an annual cycle. And from that, we whittle that down from those 3,700 to just 40 global equity managers that we think are absolutely best in class. And it's from that 40 that we've identified the 8 that, when blended together, give you the optimal portfolio for Alliance Trust, given all the objectives that Robert went through before. Now, at that point, we could just say, well, let's now invest in the standard approach that those 8 managers offer their other clients. But we didn't think that was good enough for Alliance Trust. There was a danger when you put together all of those portfolios, and sometimes they're running 50, 60, maybe 100 stock portfolios for their clients. If you put all of those together, there's a danger you end up with a very, very diversified portfolio, actually mirroring the index, the market, and therefore very difficult to outperform considerably. So instead, we've actually asked them to run very concentrated, high-conviction portfolios only made of their very best ideas. So if they don't like US equities, they don't hold any US equity stocks. If they don't like a particular industry, they don't have to hold anything in that industry. That's the principle behind this. And it's one of the reasons we think this multi-manager approach can significantly outperform a single manager approach. And indeed, when people talk about multi-manager, they tend to focus all the time on risk mitigation. But it is important to note that we think there's good reason that it can outperform significantly. And perhaps the easiest way for me to explain this is to use an analogy. And I'll use Dame Jessica Ennis-Hill. So I'll ask you to cast your minds back to London 2012 Olympics and think about Jessica's gold medal winning triumph in the women's heptathlon. Now, she was the favourite for that event in advance, and she went to victory and won considerably and got the gold medal. Now, she was unequivocally at the time the best female all-round athlete in the world. If you wanted one individual to do all 7 events in the heptathlon for you, she was your go-to person. Now, if instead, however, you'd have had the luxury to be able to pick the very best athlete in each of the underlying 7 events, you would have ended up with a better outcome. Let's take the gold medal winning performance in each of those events at that same London 2012 Olympics, and you can see the results were much stronger. If you'd gone with those specialists in advance, you would have thrown further, jumped higher, run faster. The problem, of course, is that the winners of each of those events were all from different countries. So if you were going to put this team together, you would have needed someone that could A, identify that talent in advance and pick the team, B, run that team on an ongoing basis, and C, ensure that the conditions were in place to allow each of those elite athletes to excel. Now, my reason for using this analogy is because it's exactly the same as what's happening here with Alliance Trust. We're moving from the idea of having a single generalist asset manager, ATI, trying to do everything, to saying let's pick the best specialists in each type of approach to asset management and blend those together to get a team that can produce better results. Now, one of the things I said that you need to do with these athletes is to give them the conditions that allows them to excel. Well, the same is true here with asset managers. So what are those conditions that allow asset managers to excel? Well, quite simply, this is why we're doing this best ideas approach. We're actually saying to the managers, we just want you to run your best 20 ideas in most cases. Go anywhere, as I said before. Now, it's not just us saying that this works. There's lots of academic research on this as well. And I've put up an example of an academic research paper that was done a few years ago. And what this showed was that for breaking down all the managers in the universe, as to how much conviction they show in their portfolio. So on the right-hand side, you've got the high-conviction managers running concentrated portfolios that look very different from the market, very different from the index. And on the left-hand side, you've got the ones that look quite similar to the index, very diversified portfolios. You can think closer and closer to closet index tracking. And indeed, this has been quite topical with the regulator being very negative about these managers on the left-hand side. What we're doing here is ensuring we're only focusing on the ones on the right-hand side, really high-conviction 20-stock portfolios. And this shows you that, on average, managers that take high conviction outperform significantly. This isn't even saying pick the best managers within it. It's just saying, on average, they do that, and on average, the others underperform. And so simply by fishing in a better pond, you're already upping your odds of success. And that's really what we're focusing on here with these 20-stock portfolios. And if you think about why it is that this phenomenon occurs, think about the way an investment manager would typically put together their portfolio. They'll have maybe 10 or 20 ideas that they've got a lot of conviction in. They think these companies look really attractive, so they'll want those as the big positions in their portfolio. But then they'll look at that and say, well, I can't run a 10 or 20 stock portfolio. I'm not in a multi-manager lineup. That kind of risk is too high. So what they'll do is they'll fill the portfolio with a number of other stocks for risk reduction reasons. So they're not there for return-seeking reasons. They're there for risk reduction reasons. And as a result, you end up with worse outcomes, and hence the position on the left-hand side. What we're doing here is saying, well, you don't need to worry about those risk reduction positions. We'll worry about that by the way we blend the managers together. Just give us your best ideas, the one that produces those results on the right-hand side. So when you put that together, you can really tilt the odds in your favour. So on the left-hand side, the idea of having one skilled generalist manager that I referred to, akin to ATI in the current environment. And let's say you assume that manager is going to be able to achieve the performance objective that ATI have been set, which is to outperform by 1% per annum over the very long term after costs. So if you know in advance that that manager is going to achieve that, the probability that they'll do it in any 5-year period is actually about 70%. If instead you pick equally skilled managers, and I've just talked about why I think you can pick more skilled managers if you're going down the specialist route than the generalist route, but let's for the minute just assume they're of the same skill, but you pick 8 of them and ask them to run more concentrated portfolios, you tilt the odds to more like well over 90% chance of outperformance over a 5-year period. Now, an obvious question at this point is, okay, but this all sounds quite theoretical. Is this untried and untested? Is there any track record out there that implies this has worked in the past? And what I'll show here is a couple of track records of what we've been doing in this space for quite some time. So the first point is this is not untried and untested. We've been doing this for 10 years. So on the left-hand side, I've put up there the track record of the client we've been doing this with the longest. So I started working with this charitable foundation client, multi-billions in this charitable foundation client's assets, about 10 years ago. And what they asked us to do was to continue to give them new ideas, new managers that they could put in their portfolio that are running 10 or 20 stock portfolios, and then they'd equal weight them. And what we've put here is the track record, the most recent track record that we had of this client. And I took the 5-year period. And over that 5 years, that portfolio has outperformed by 3.3% per annum. Now remember, the objective for ATI today is to outperform by 1% per annum. Our objective going forward under this new arrangement is to outperform by 2% per annum. And over this 5-year period, we've outperformed by 3.3% per annum. Now, recognise I said we've been working with this client for 10 years and I've chosen the latest 5 years. So you might ask, am I picking the period that looks better? No, I'm not. Actually, over the 10 years, it's an even better track record. It's more like 5 or 6% per annum outperformance. I just chose the latest period because it's more recent and because it's when they've had more managers than the 8 that we're talking about for Alliance Trust. So it didn't look as though I was just picking ones where there was 1 or 2 managers that swayed the numbers. Indeed, this approach was so successful with this charitable foundation client that 17 months ago, we launched a fund so that more of our clients could get access to this. Now, this fund, the Global Equity Focus Fund, is only available to institutional clients. So it's primarily UK pension funds, corporate pension plans that are invested in that. Now, that's only been going 17 months, but that has also outperformed by nearly 3% per annum after costs over that period as well. So again, I'm not using these track records to say it's proof that Alliance Trust will definitely outperform going forward. But what this does do is show that this is not untried and untested, and that indeed we are taking the kind of levels of risk, even with a 200 stock portfolio, that can achieve at least the target outperformance that's been set. Now, an obvious question that comes up from this is, well, okay, but now you've got Willis Towers Watson in place as well as the best managers in the world. Surely this is all very expensive. Actually, the answer is no. We're able to deliver all of the advantages that I've just talked about with that great track record historically, such that the total costs on the entire trust, the entire costs of Alliance Trust, will be in at less than 0.65% per annum, even with the reduction in the size of the assets should the buyback of Elliott go through as well. So even if the assets shrink by 20% and we pick the best managers in the world and we have Willis Towers Watson in place to oversee all of this, then the costs come in at this level. And what I've done is I've put that on a chart relative to all the other total costs in the investment trusts in the same sector. First thing to say is that it's below average. In fact, it's well below some of the trusts on the right-hand side where the costs are over 1% per annum. Other thing to note is that most of these trusts are single manager approaches, so they don't have all the advantages that I've talked about in this new approach. If you compare it just to the ones that are multi-manager, which are some of the ones on the right-hand side, it looks much more competitive in cost terms. And the reason that we've got two colours on here is because some of those charge performance fees, so we've allowed for that as well. We don't charge performance fees either at Willis Towers Watson level or the underlying manager level going forward for Alliance Trust. So this really is a more predictable cost going forward. So why on earth are we able to get the managers at such low costs? Well, there's three reasons. First one, I mentioned earlier that only 3 of these managers are even available, have any brand whatsoever in UK retail space. Well, imagine they get offered the opportunity to be associated with the Alliance Trust brand. And they get splashed all over the papers for the last couple of weeks for free marketing. Sounds quite interesting. Secondly, they get access to Willis Towers Watson, with $2 trillion of assets under advice. They're interested in getting into that client base. And thirdly, they find it intellectually appealing. If you go to any of the world's best stock pickers and say to them, are you interested in running a 20-stock go-anywhere portfolio where you don't have to hold any stocks for risk control purposes other than thinking about absolute risk of permanent loss of capital in the underlying companies? They're all very interested. That's how they would run their own money. They'd love to do that all day. But it's usually their risk teams or their marketing teams that don't let them. Here they can because it's part of a multi-manager approach. Final slide from me, just to introduce you to the team that will be running this at Willis Towers Watson. So in the same way that the whole idea behind this is such that investors in Alliance Trust, yourselves, are not reliant on any one individual portfolio manager or any one style, similarly, we don't want you to be reliant on any one individual at Willis Towers Watson. So we're running this as an investment committee. I chair that committee, and the 4 faces on here make up that committee. I'll just make 2 points about this before handing over to David. The first is that this is a very experienced team, 80 years of experience between the 4 of us, and 58 of those being with Willis Towers Watson, so we know each other well. And the second point is that this is the same people that have been responsible for creating those track records that I referred to before. So at that point, I'll hand over to David, who will introduce you to some of the managers.
Thank you, Craig, and good afternoon. I'd like to continue Craig's analogy now about the elite athletes to talk to you about the elite financial athletes who we've asked to manage money on behalf of Alliance Trust. They're the investors who will be selecting the stocks to generate the dividends, dividend growth, and capital growth that the shareholders are looking for. And it's our job at Willis Towers Watson to make sure that we blend those into a robust mix capable of outperforming the market in all eventualities. And to do that, we think it's best to use a range of specialists with different skills in different areas. There are the growth specialists, who are tasked with finding tomorrow's winners, the value specialists, who are great bargain hunters, the quality specialists, who look for businesses capable of great compound growth. Now, some of these are successful over a shorter time horizon, and some of them need a longer time horizon. But they're all great stock pickers who can go anywhere to find the bargains that they're looking for. Why would we restrict some of the best stock pickers in the world? And similarly, we'll go anywhere in the world to find great managers. So for Alliance Trust, we've selected managers from the UK, Canada, and across the United States. We're going to hear from some of those managers in a second. But before we do that, we're going to look at the names, and some of those I think will be familiar to you. As Craig said, 3 of them have a UK presence. However, it's not possible to access their best ideas portfolios in any way other than through Alliance Trust. So these are all their global mandates. Some of them run other money as well. But we think that they have got ideal environments. They've created those environments. They've often worked in bigger investment organizations. They're all top rated by Willis Towers Watson's research team. And we're going to hear from some of them. And they've made a commitment to you that they will come to Scotland and to England and will rotate through this portfolio so that you'll get to know them as well as Willis Towers Watson in the future. And they'll tell you about their investment approaches. But short of that, today, we're going to play a couple of videos from them. And you'll see some of the characters that are now surrounding this slide. And they'll tell you about their approaches and how they look to add value over time. And it's our job to make sure that they don't overlap with each other. As Craig was saying, we don't want the sum of all these great managers to add up to the index. And in actual fact, there's very, very little overlap between the managers, almost none, and very little overlap with the index. So they can reasonably expect, if they pick the right stocks, to outperform. We're going to hear from one of the managers now, Bill Canco, round at Black Creek. Now, I should warn you, Bill is slightly dour. Hopefully that's okay. He is an exceptional stock picker. He's not going to blow his own trumpet. He set up his organisation a dozen years ago with his colleague Richard Jenkins, and they were regarded as 2 of the most excellent investors in Canada at investing in international and global stocks. So let's pass it over to Bill to hear in his own words about how he does things round at Black Creek.
I'm Bill Canco, the founder and president of Black Creek Investment Management and the head of our global equity team. Black Creek was formed more than a dozen years ago to create a global equity investment shop that could be home to passionate and capable investment professionals, free from the forces of public or institutional growth imperatives. Since that time, we have grown to manage about $5.5 billion of assets in global and EFI portfolios. We have 6 people on our equity investment team, and the combined experience of this team in managing global equities is more than 120 years. I have been an analyst and portfolio manager since 1981. Black Creek is primarily owned and operated by the investment professionals. Just as important, we have our own money invested alongside that of clients, so it's not just a game for us. As I like to say, it doesn't guarantee performance, but it certainly makes us pay attention. For more than 2 decades, we have shown that a portfolio focused on relatively few leading global businesses that are misunderstood or misperceived by the market can add value over time. This approach requires independent and sometimes contrarian thinking. More than that, it requires a constitution of character amongst the investment professionals to withstand the inevitable shorter periods of time when you look completely different and quite possibly wrong in order to add value longer term. Macro factors and the big picture are relevant to what we do, but that's just the playing field for the companies we invest in. Our focus is on individual businesses and why they will be bigger and more profitable in the future to the surprise of other investors. We look at businesses from a long-term fundamental point of view, and then we work to have a view of those businesses that is different from the rest of the market. We choose to have focused and concentrated portfolios of individual investment ideas, as we believe that this is the source of value added over time. Our idea generation is the art in what we do. In an era of endless algorithms and vast computing power, we believe that any investment strategy based simply on metrics can be easily and more cheaply replicated by computers. Don't get me wrong, we pay attention to the numbers, but our secret sauce is the imagination and idea-generating capability of our portfolio managers. We are honored to have the privilege and opportunity to work for the investors in Alliance Trust. Thank you.
Great. So that was Bill in his own words, and hopefully that chimes with what I'd been saying earlier about a manager who designs an investment management organization to bring the best out of their skills. I'm going to turn to another manager now who's more recently set up his own organization, Rajiv Jain, around at GQG Partners. That stands for Global Quality Growth, so you'll know what his style is likely to be. Rajiv will tell you a little bit about his background, an outstanding investor in both developed markets and emerging markets. And for Alliance Trust, we're looking to take advantage of his skills both in developed and emerging markets. So he'll be managing 2 portfolios, one of which will be devoted to emerging markets. But remember, they can both go anywhere in the world to find the right stocks for the portfolio. We're going to listen now to Rajiv, who you'll hear has just got a slightly different style.
Hi, my name is Rajiv Jain, and I'm thrilled to have the opportunity to present to you. I worked with Willis Towers Watson for many years, so they know me well. I managed EM for over 20 years through 10 bear markets. So if Willis Towers Watson has seen me in good times and bad, and I'm happy to say our relationship has stood the test of time. For those of you who don't know me, I worked at Vontobel for 22 years, where we built an asset management business to nearly 50 billion in AUM before I left just under a year ago. I started GQG because I wanted to build a boutique based on the values that I hold as an investor and an entrepreneur. I've always felt managing people's money is a privilege. As professional investors, we should strive for perfect alignment with our clients. That is why I've invested majority of my net worth in the same strategies I manage for you. In terms of strategy, we believe in buying high-quality companies. We are focused on the very long term and believe we can form a differentiated view on the company's valuations and prospects based on taking the longer-term view. We employ journalists and forensic accountants to help us create a unique perspective. One interesting thing we saw in the market this year was the extreme flows and therefore high valuations in most of the stable names. Low beta ETFs drove much of this. Simply put, we think the most stable names are expensive, while the high quality names that may have slightly less stability are cheap. So we are repositioned our portfolio significantly last year, selling out staples exposure that we've held for quite some time. We believe that fierce competitive drive is the key to success in this business. That's why equity ownership and entrepreneurship are so important. We are building the right culture and creating the right incentives to keep the best talent. Thank you for considering GQG. We hope to earn your business.
Great. So we've now heard from a couple of the managers. We talk about WTW's role in assembling this portfolio. One of the important tasks that we have is to make sure the group of managers can continue the dividend and dividend growth record that shareholders are so rightly proud of. And the way we do that, and it's important the way we do that, is to make sure that we're selecting some managers within the mix for whom income and income growth is a natural part of their process. We don't want to compromise any of the managers' returns or ask them to do something which wouldn't fit with their style. We've been able to do this in the portfolio we've put together for Alliance Trust, such that the income off the portfolio, its dividend-paying capabilities, is slightly higher than the existing portfolio. So we think that positions us to continue the excellent record of dividends and dividend growth. We're also ensuring, as Craig alluded to before, that these managers do different things in the portfolios, that there are very limited overlaps and that they don't sum to the index. We also want those managers all to contribute. We don't want them all to be doing the same things. We want them to contribute at different times, according to different market conditions. But in principle, we'd like them each to roughly equally contribute to the portfolio. And we ensure that when we're constructing this portfolio, that it's what the managers are good at, which is stock selection, which drives the portfolio. We don't want to get it thrown off course by a geographic weighting or a currency weighting or a style weighting, which we could otherwise moderate. So what does the portfolio look like? compared with the existing portfolio. You'll see some purple lines here and some grey sort of black lines as well. The purple lines are the proposed portfolio, and the grey is the current portfolio. And you'll see at top level, they're rather similar. And that's because the areas of the economy and the sectors within the economy where stock pickers find interesting companies, those are the biggest sectors often. And so they're very well represented in the portfolio. However, at the next level down, the individual stocks, the stocks that we're tasking these stock pickers to pick, are completely different, such that the portfolio is over 80% different to the index. So whilst it looks similar, the risk is very, very similar, we're actually somewhat less exposed to any individual stock, should anything go wrong with a single stock. But the portfolio is still driven by these stock views coming from the managers. So that's all I wanted to say, and I'd like to hand back to the chairman to wrap up and take your questions.
Well, ladies and gentlemen, I hope you found Craig and David's presentation helpful. We're aware that the last few years have been not without incident. Over the last year, we've spent as much time as possible consulting with investors about the direction we should choose. We're unable, obviously, to consult individually with everyone, and that's why we're here today and why we've chosen to call a general meeting to put these changes to a vote. The board is very excited about the future for Alliance Trust, and we're pleased by the market reaction. We're determined to restore the trust to former levels of performance, and we firmly believe that this will put Alliance Trust on a strong footing for many years to come. Now, the meeting to vote on these matters will be held on the 28th of February in Edinburgh, and if you can't make it, I do urge you to vote in favour by proxy.